I think that U.S. Treasuries potentially did see an overreaction. If that's the case, then financials do look cheap right now on a tactical play. So the market seems to be positioning itself in favor of defensives. Of course, utilities, staples, expecting that deceleration. But let's see for a second. Let's think if the Fed doesn't cut and economic growth does pick up or even stay pretty good. Then we will get U.S. 10-year yields rising and financials outperforming. So, look, I think there's a lot of guys looking to reposition their portfolios, defend their profits. You know, the market has rallied in a tremendous way since December when we recommended our clients go long. At this point, what we're recommending now, Sarah, is really protecting your profits and really getting more defensive.
Speaking of defensive and utilities, despite faltering at the end of last year, tech stocks have had a massive run-up with FANG names like Microsoft, all seeing double-digit gains so far this year. Mike, you've been looking at the unlikely winners in this market, tech and utilities. Yeah. You don't usually think of them in the same sort of psychology around the market.
It's a little counterintuitive, but tech, in this case, mega cap tech, does serve as a little bit of a defensive function. So what I read it as is the market is searching and rewarding stable cash flows, long-term assets that are going to deliver a stream of cash flows. That does mean utilities, it does mean real estate, investment trusts, and it does mean these big tech platform companies. The question to me is whether, again, we've kind of overemphasized that theme and now it may be ripe for reversal, or is it just the market's way of saying, look, while we have lack of clarity about exactly what the pace of the economy is globally and about trade, maybe we can kind of hide here for a bit and have the tape hold together on some of these yield plays and strong cash flow plays. That seems to be what the message is for now. I just don't know how much we can extrapolate this out a few months.
Kathryn, what do you make of that slightly odd balance of defensive, that there's some growthy, expensively valued tech names thrown in there with the yield plays? And what are some of your preferences for that kind of defensive type characteristic?
Sure. Yeah, it's a really interesting piece, the one that Mike wrote on CNBC. I think it's an interesting dichotomy between, you know, the outperformance in tech and utilities, and I really do think that it does come down to where the market feels comfortable. Where do they see cash flow going out in the future? Which are the sectors that in a downturn, which is inevitable, at some point we are going to get that recession, whether it be in 6 months or 2 years from now, where their money is safe. So that's what we're seeing. We're seeing the likes of the bond proxies really outperforming. And I think that's a smart play over the long term, over the year, 2-year time frame, positioning oneself for that downturn. But in the meantime, we don't want to miss the upside, right? We don't want to you don't want to fall into that trap where we say, okay, U.S. recession is around the corner, when in fact it's not, right? You have to be careful about how you interpret the yield curve inversion and the role that the Fed's hand has played in that.